What if I told you that the next stock market crash might already be predictable? And what if that crash is being quietly linked to one specific year, 2027? It sounds crazy, but a lot of investors are starting to ask the same question. So today, let's break this down logically, not emotionally. Market crashes are nothing new. They've happened before and they will happen again. But every time a potential crisis approaches, people try to do the same thing, predict the exact moment it will happen. And right now, 2027 has become a focal point of speculation. But is there any real data behind this, or are we just repeating the same cycle of fear? So why are people even talking about 2027? It comes down to a mix of patterns, indicators, and psychology. If you look at history, major crashes often follow long periods of growth. After extended bull markets, valuations stretch, risk-taking increases, and eventually something breaks. Some analysts believe we are currently in a late-stage cycle, and if that's true, the next downturn could happen within a few years. That's where the 2027 idea comes from. But here's the problem. Humans love patterns. We look at past crashes, 2000, 2008, 2020, and try to find a rhythm. But markets don't follow a fixed schedule. If they did, everyone would be rich. The reality is, patterns can give clues, but they don't give certainty, and relying too heavily on them can actually be dangerous. So what actually causes a market crash? It's never just one thing. It's usually a combination of factors building up over time. Economic cycles play a huge role. Every expansion eventually slows down, and recessions are part of the system. Interest rates and inflation also matter. When rates rise, borrowing becomes more expensive, liquidity drops, and markets come under pressure. Debt levels can amplify risks, especially when both governments and companies are heavily leveraged. Geopolitical events can trigger sudden volatility, conflicts, trade tensions, instability. And then there's investor psychology. Fear spreads fast, and once panic starts, selling accelerates. Now, here's something new. Today's markets are very different from what they were 20 years ago. We now have algorithmic trading, AI-driven analysis, and real-time global data. In theory, this should make markets more efficient, but it also creates new risks. Because when machines react at the same time, they can amplify volatility instead of reducing it. So technology doesn't eliminate crashes, it just changes how they happen. So let's answer the big question. Can you actually predict a market crash? The honest answer is no one can do it consistently. Even top investors and economists get it wrong, because markets are not just numbers. They're driven by human decisions, emotions, and unexpected events. And those things are impossible to model perfectly. So if you can't predict crashes, what should you do instead? Smart investors focus on preparation, not prediction. They diversify their portfolios, manage risk, avoid emotional decisions, and think long-term. Because crashes are not just threats, they're also opportunities, but only for those who are ready. So will there be a crash in 2027? Maybe, maybe not. But the exact year matters less than understanding this. A crash will happen eventually. That's part of how markets work. The real question is not when it happens, but whether you're prepared when it does. What do you think? Is 2027 realistic? Write your opinion in the comments. And if you want more deep insights into markets, investing, and financial strategy, subscribe to the channel.
You can stand under my umbrella.